Welcome to my channel where I try to break down accounting and tax topics to help small business owners, taxpayers, or anyone else who's just genuinely curious. In this series, I'll be covering college accounting with the hopes of introducing you to basic accounting principles. This will help in your coursework or help you in your small business. Today specifically, we'll cover assets, liabilities, owner's equity, and expense and revenue accounts. This is essentially an introduction to hopefully start building a foundation to help you better understand accounting and the impact of the transactions that you do in your business. So when I first started in accounting, I was kind of scared because I heard of all the horror stories coming out of my introduction to accounting class. My class was split into 3 different parts, and you had to pass each part to continue. And I know people who could never get out of the second session, so I wasn't sure what to expect. Long story short, I made it through unscathed, but some of my counterparts weren't so lucky. So hopefully after this series is complete, you'll be more prepared for class, or you'll learn enough to decide that maybe accounting is not your thing. Either way, let's get into it. Let's first outline the accounting equation and cover some of the basics. The accounting equation is fairly simple. All it is assets equal liabilities plus equity. Now this is where the rubber meets the road and is the start of your journey into accounting. So what are assets? Pretty self-explanatory, but we'll define it as things of value owned and controlled by an entity. This could be things such as cash, equipment, buildings, desks, computers, pretty much anything. Most oftentimes, these are tangible items that you can physically touch, you can hold them, or you can use them in a course of day-to-day business. But they can also be intangible, or something that has a value but you can't physically see. An example of this would be accounts receivable. So if you make a sale in your business and you issue the customer an invoice, the invoice would go on your books as a receivable. This has value because the customer actually owes it to you. And if you wanted to, you could sell that receivable to someone else for cash, or you could hold it until the customer pays. So liabilities represent debt owed to entities or creditors. They can originate with the purchase of products, services, etc. on credit. Now these create an obligation for the business. So if you purchased a truck to use in let's say a lawn care business, by taking out a car loan, the amount of the loan would obviously be the starting point of your liability account. However, these are not necessarily limited to typical loans or liens. For example, if you order products from the store and they send you an invoice after they release the product to you, then that would go on your books as a liability as well. Owner's equity is basically the owner's right, claim, or financial interest in a business. Oftentimes you'll hear this referred to as capital or a capital account. Usually this will start out as an investment in a business. So like let's say if you started a company and you purchased equipment, the purchase price or the amount of cash that you put in the business would be the initial balance of your capital account. This account will increase and decrease based on revenues, expenditures, owner's draw, etc. And we'll cover more on that a bit later. So now we have a basic understanding of the accounting equation. Assets equal liabilities plus equity. So most people that start a business don't realize the transactions that are happening when they open up shop. For example, if you owned a lawn care business and you bought a lawnmower on credit or you purchased weed eaters with cash, a few entries are happening without you even realizing it. So let's start out with the weed eater. Let's assume the weed eater is $200. This initial $200 cash investment would go on your books as a $200 asset. It starts out as cash, which we would then use to purchase the weed eater and expense it. Again, we'll cover more on that later. So you would have a $0 liability because this is a cash investment. And then you have $200 in owner's equity, which is the financial interest you have since you invested $200 in the business. So the accounting equation holds true. So now we move on to the lawnmower that we purchased on credit via a loan. We would add the $2,500 asset, which is a lawnmower. We would also add a $2,500 liability because we borrowed the money for the purchase for the lawnmower, and then there would be no changes to owner's equity at this time. In total, the equation would look like this: $2,700 in assets, that would be the lawnmower and the cash that we're going to purchase the weed eater with, $2,500 in liabilities, which would be the lawnmower, and then you'd have $200 in owner's equity from the cash investment in the weed eater. So now, as you can see, if we tracked everything that we did in our business, this would get unmanageable pretty quickly. This is why we utilize systems such as QuickBooks or other ERPs to track to make all the entries for you. Revenue and expenses both impact owner's equity. Expenses decrease owner's equity and revenues increase it. So in our prior example, we invested $200 cash, which had this impact on the equation. $200 in assets because it would be cash, again $0 in liability, and then you'd have $200 in owner's equity. So the purchase of the weed eater would generate an expense. This would reduce the cash of $200, and then an expense of $200 would reduce owner's equity. And then when we start making payments on the lawnmower, we would again reduce cash and expense the payments, causing a further reduction in owner's equity. When you make the sale of products, services, or whatever it is that you're doing, you would increase your cash. However, if you make the sales on credit, you would increase accounts receivable. Both of these are assets. So let's say if you cut a lawn for $100 cash, and then you cut another lawn for $250 and issue them an invoice, i.e. on credit, the first one would be a $100 increase to cash, no impact to liabilities, and then an increase of owner's equity of $100 for the revenue. The second entry would be a $250 asset, accounts receivable. Again, no impact on liabilities. And then it would be an increase of $250 for owner's equity for the credit sale. Now, as you collect on a sale, you would both increase and decrease your assets, right? You would increase your cash once you collected it, and you would decrease your accounts receivable because they no longer owe the bill. If they paid you in full, you would increase the cash by $250, and then you would reduce the accounts receivable by $250. Since those netted out to zero, there would be no impact to liabilities or owner's equity. Now we'll add up the additional transactions to tie out our accounting equation. For assets, we have $2,700, which consists of the initial cash and the lawnmower. Then we have a reduction for the purchase of the weed eater and $350 in sales for total assets of $2,850. There were no adjustments to liabilities, so those will remain at $2,500. And then we have owner's equity, which we started out with our initial investment of $200, and then we had adjustments for the purchase of a weed eater as an expense and $350 in sales for a total net change of $150. This leaves us with a net balance of $350 for owner's equity. And as you can see, our accounting equation remains true. We have $2,850 in assets, $2,500 in liabilities, and $350 in owner's equity. So this is the first video in my Accounting 101 series. In our next video, we'll dig into T accounts, debits, credits, and financial statements. Thanks for watching. Be sure to subscribe if you haven't already done so, and I'll see you in the next installment.